Hi, and welcome to the Stockscores Market Minutes for June 1st, 2015. This week I want to talk about the importance of using multiple time frames when you are analyzing any stock. I like to use the longer term time frame to tell you what to do and the shorter term time frame to tell you when to do it. So if I'm day trading, I'll look at the daily chart to see is it worth buying at all, and then if it is, I'll look at the intraday chart for my entry point. If I'm longer term position trading, I might look at the weekly chart to tell me, yes, the stock should be bought, but then look at the daily or even the intraday 30-minute chart to pick that precise moment to make the trade. Before making a trade, analyze the charts on multiple time frames. Let me show you what I mean. Here's a stock that has a pretty good daily chart. It broke out on Thursday from a rising bottom. That's a good reversal pattern. But notice also that the following day on Friday it pulled back. Well, if I take a look at the intraday chart, I can see that pullback, and what I would do is wait for a break of that pullback on the intraday time frame as a cue that the little bit of profit taking that comes after the big breakout is now over and it's time to take the trade. All right, let's get into this week's analysis. Here is a chart of the S&P 500 on a 30-day, 60-minute interval. And you can see that the past week we had a little bit of selling pressure, some falling tops there over the last 4 days of this week. Of course, it was a holiday shortened week. We haven't broken any upward trend lines, so it's not particularly bad. It's just the market's really having difficulty making that breakthrough long-term resistance. The buyers lack commitment. In the longer-term weekly chart of the S&P 500, you can see that the bull trend remains in place, kind of in the middle of the upward sloping channel, but what I want you to notice is how narrow the bodies are on these candles over the last 5 or 6 weeks. That makes for a difficult trading environment. There is just no volatility in the market. It's completely complacent. The buyers don't care, the sellers don't care. They're just sitting there doing nothing, and that makes for a tough trading environment. Now that typically comes before a break into a new trend. What you tend to get is this sort of calm before the storm, this coiled spring that winds up with low volatility, and then one side or the other takes action. Now the question is, what side will take action? Will it be the buyers or the sellers? Well, given that the trend is up, the probability is greater that it will be the buyers. When the trend is up, we would expect the buyers to be that breakout type motion. But it's not impossible that the sellers could cause the market to break down and break that green upward trend line. So until you see the break, you don't really know what to do. For now, I would just sort of sit on your hands and wait for great trades to come along. They do come, you just have to be patient. And then when they do come, take advantage of them, but don't be too enthusiastic about the market in one way or the other until we get a break out of this trend. You can see the volatility diminishing on the Russell 2000 as well. I've drawn the green line of support and the red line of resistance, and the fact that those two lines are converging toward one another tell us that volatility is compressing. And as we get to the pointy end of the triangle, we get to that point where the market will break one way or the other. And again, because the trend into the pennant is up, the trend out should also be up. TSX 60, a little bit more of a bearish pattern set up over the last month. You can see it's been basically trending downward for about 3 weeks, and that is maybe even 4 weeks. And that just demonstrates, I think, the concern that the market has about Canada's emphasis on energy and oil. And of course, with the collapse in energy prices, you're starting to see that take an effect into the market. It's still not bad when you look at the long-term chart. We're still in a long-term optimistic pattern build where we've got rising bottoms over time, but I want everyone to be a little cautious with this, because if we do break down and ruin this cycle of rising bottoms that has been underway for 5 or 6 months, well, then we stand to possibly see more of a sell-off. The small cap stocks in Canada, or micro cap stocks, the TSX Venture, remain stable, no catalyst here. Again, people just don't care. The buyers aren't acting, the sellers aren't acting, and you're going sideways in a relatively narrow range. Treasuries made a little bit of a bounce back. I expected that it would last week. I think that could materialize into more of a bounce back over the next few weeks as the market gets back to that red downward trend line that I've drawn on the chart. That rise in that rise in bond prices means a drop in interest rates. So if you're looking to get a mortgage, you might want to wait another week or two because the rates could get a little better for you. Not going to be a lot better, I'm not going to lie to you, but it could be a little better anyway And so wait for a couple weeks on that. Here is the chart of the US dollar. It rallied up to that red downward trend line. That's basically the pullback line in the longer term upward trend. What we expect to have happen when it hits that is for price to roll over and move back down again. The alternative, of course, is that it breaks the pullback. And so if you get a break up through that red line, then people are buying US dollars again with enthusiasm, and you want to be cautious. However, for now, it looks like the US dollar is going to roll over and head lower. Gold remains in that downward sloping descending triangle. We call that pattern where the tops are falling towards a flat line of support. That's a bearish pattern. Until we break out of that bearish pattern, I want everyone to be generally cautious with gold and gold stocks. Now, a gold miner that makes a big gold discovery, sure, that can go up, but most of them are not going to go anywhere. The oil market had a little break to the upside. It was in a pullback phase mostly because the US dollar was rising. And so I was a little concerned about oil last week, but right at the end of this week on Friday, you can see that it broke the pullback line. So that should lead to higher prices in oil in the near term, especially if the US dollar does get stuck at that pullback line that I just showed you. US dollar rolls over, oil moves up, there's a little bit of tension in the Middle East, as there often is, and so those things can help the oil market move higher. I think that right now oil looks more likely to go higher than lower in the short term. Fear, this really shows the complacency of the market. There's just no fear, there's no concern, people aren't speculating, and that is why the VXX, the VIX, is at those major lows. All right, so US stocks, bullish long-term, neutral short-term. Canadian stocks have been in a sideways range for some time, so I'm neutral on both time frames. Bearish in both time frames for gold. Bearish long-term for oil, neutral short-term. I have a little more hope than I had last week, though. We could see oil start to tick back up this week. The market is stable, and really it is too stable, and that is making for a difficult trading environment. Periods of low volatility are typically followed with strong price trends, so we just need that break from the narrow range that prices are in. The US dollar is showing some signs of rolling over, which would be supportive for oil. It should help gold too, but it hasn't been. But I think the real strength is going to be in oil and its attempt at moving up. Well, that has been the Stockscores Market Minutes for June 1st, 2015. Have a great week in the market and trade well.